So guys, let's get started. So my name is Tim Hart. I'm the Director of Private Mortgages Australia, and I just want to walk you through about sort of how private lending works and sort of some of the successes we've had sort of over the last couple of years, and how it's something you can use to help your clients in the marketplace. So let's have a look. Private lending in 2017. So PMA, Private Mortgages Australia, our focus has very much been on educating the market, and it's really paid off for us. What we've done is a lot of the time it's just these webinars that we put on. We put them on consistently over the last couple of years, and we always get really, really good feedback. And where that's paid off, we've seen we've basically seen there's been a 210% increase in the number of loans settled last year, and a 236% increase in the loan volume last year. And that's purely on the basis that we're educating our referrers on what private lending is, because it's something that's becoming more and more mainstream. It really sort of breaks our heart when we see some, a broker or a borrower sort of say, look, they lost their deposit, or they couldn't settle on something, or something happened because they couldn't settle on a property. They're under a rescission notice and they couldn't settle in, a couple of days' time or a week, or the bank just simply said no. So many different scenarios where the banks just simply tighten up and say, no, we're blanket policy, we're not going to lend to that person for whatever reason, whereas private lending is very, very flexible. And if you don't get anything from this webinar other than that, just know that private lending is very, very flexible. That's what it's all about. And that's what you're paying for. That's what the client is paying for, is that flexibility and the speed in which they can get the funding for. So let's just jump straight into it and look at what the products are in the marketplace. So the first thing you'll notice is that we do business finance. Okay, so we don't do consumer finance. So someone that wants to buy their own home, or they want to go on holiday or buy a car or a boat or something like that, if it's for a consumer purpose, we can't do it. So we only do it where more than 50% of the loan is for a business purpose. So let's look at our three products. We've got first mortgages, second mortgages. We also do caveat loans. Now, our interest rates for first mortgages are anything from 1% to 2.5%. Now that's PCM. Now that stands for per calendar month. That's not per annum. And that really shows you the sort of the terms that we look at. Okay, usually people are coming to us because they need money usually quite quickly, but also for a short period of time. So our average loan is around about 4 months. And with extensions, it can go to usually around 6 months is our average loan term. So for first mortgages, we do anything from 2 months to 36 months with amounts from $50,000 to $2 million. Second mortgages, they do carry a little bit more risk. So they're at 1.5% to 3.5% per month. Time frames for those 2 to 12 months, and loan amounts from $50,000 to $1 million. The last one we've got is a caveat loan, where we simply do not have the time to even register a mortgage. This is only a product that someone would need if they're going to they need funding within a couple of days. So interest rates are a lot higher, where your client they're basically paying for the speed in which they're getting the funding for. So you're looking at 3 to 5% per month and much shorter time frames. So we'll only do 2 to 6 months for these caveat loans. They're not designed to be a long-term solution. And the amount's $50,000 to $500,000. Now let's look at, and we really want to, we're all about transparent lending processes here. So we really want to sort of show you a bit of our lending guidelines and our credit policy. So this is our loan to value ratios that we look at. So basically how much we'll actually lend your client. So we actually break our loan to value ratios into 4 categories. Now these are actually the Genworth financial postcode categories. So Genworth Financial, one of the 2 mortgage insurers in Australia, and they basically break every single suburb in Australia into 4 different categories. So to give you a bit of an idea, category 1 is most properties in Australia. So anything that's within, say, 50 k's of say a major capital city like Melbourne, Sydney, Brisbane, is typically category 1. Major regional centres where you're getting a little bit further out, they're usually category 2. Then category 3 is usually a little bit further out again. You're looking at sort of smaller towns. and then category 4 is whoop whoop. Okay, that's our technical term. Just a property that's like in the middle of nowhere or a very, very small town. Usually a lot of banks won't even lend to category 3 or 4, but you can see we will lend there, but the amount we'll lend is usually significantly less than if it was a residential house in suburbia. Now the other thing you'll notice is we've got a column there that says maximum. So having said all that, even having said that we'll only do 75% for a residential property in category 1, we do have discretion to go up to 80%. Okay, so this private lending, it's all about flexibility. So for us, we can actually go higher than what we've quoted, but it has to make commercial sense. Okay, it's all about us being flexible and working out a solution that's going to work for the client. So usually it comes around for us, probably one of the biggest things is the exit strategy. And we're going to talk about that in a moment, but it's how are they actually going to pay the money back. So if a client has, let's say they've sold their property and it's going to settle in 90 days, that's a pretty good exit strategy. We can see they've already sold it. We know they're going to get the money in 90 days. Therefore, that might give us the inclination that we're going to increase that LVR to a little bit higher. Okay, so we're happy to be flexible. As long as it makes commercial sense, we're happy to do it. So let's look at the fees and charges. This is something that a lot of people talk about when it comes to private lending, and it's not always the interest rate that we see that's a big issue for people. It's usually the fees and charges that you really got to be careful of when you're dealing with some particular private lenders out there. So for Private Mortgages Australia, we just charge a very low assessment fee whenever we have a deal that comes in. So it's between $550 and $770 based on the complexity of the deal. Majority of our loans are at that 550 mark, where there's only a couple of security properties that are involved, and that's it. Whereas we're talking about, a dozen, properties involved and multiple people, then it's probably going to be around that 660 to 770. So it's all just based on the complexity of the transaction. In the event that we do need to do a valuation, which we don't always need to do, but if we do, it's done at cost. And any legal fees that we do to document the loan is all done at cost. So we literally make no money. It's just a flow through, done on a flow through basis. The only fee that we've got that we actually make something from is the approval fee. So we have minimum approval fees based on the loan amount. So if the loan's less than $100,000, the minimum approval fee is $3,000 plus GST. If the loan's between $100,000 and $500,000, it's 2.5%, and for more than $500,000 loans, it's just a flat 2% plus GST for the approval fee. Now, the way we work with our referrers is that, because obviously we want to make sure that our referrers are well reimbursed for their time, we almost exclusively work with referrers and mortgage brokers is where we get our business from. So we really want to make sure we look after them, and this is why we do a lot of the education around this as well. So there's a couple of ways that you can get paid for sending loan inquiries through to Private Mortgages Australia. So either you can mandate your client directly, so you can just charge them a fee for getting the loan. Now, if you don't have a mandate, we've actually got a sample one we got our solicitor put together. It's on our website at privatemortgagesaustralia.com.au. Go to the resources section and you can download your own mandate. Alternatively, what probably 90-95% of our referrers do is they just add to our approval fee. So let's say it's a $500,000 loan and our minimum approval fee is 2%. The broker might say, well, look, I'd like to make, 1.5%. So we will then add that to our approval fee. So the approval fee will then be 3.5%, and everything is disclosed to the borrower. So we will say the approval fee is 3.5%, of which 1.5% is going to your referrer, your mortgage broker, whoever it may be. The other thing we do is a 20% future deal bonus. This is something I'm not aware of anyone else in the marketplace that does this, and this is where we really respect that if you send us a client, that's your client. That if you send us a client and if that client ever comes back to us directly, that we will actually pay you 20% of the approval fee even if you did nothing, even if you weren't involved with the transaction whatsoever. Okay, so it's just a bit of a way of us thanking you, and it's almost like a trail, if you like, that if that client comes back, we're gonna thank you for bringing that client to us originally. Now, if that client does come back through you for another loan, then that's fine. You can mandate or add to the referral fee, add to the approval fee like you normally do, but it's just in those scenarios if they come direct. The last one we've got is a referrer rewards program. And so this is just a bit of a bonus, really. It's something we add on top of, and I'll just show you on the next slide what it looks like. So once you've referred $1 million worth of loans through to Private Mortgages Australia, now this is settled loans, but once you've referred that through, we'll send you a $250 gift card, so either Myer, Dan's Murphy's or Flight Centre, or if you don't like any of those, let us know. We can get you a gift card from wherever. You hit $2.5 million, that's when we'll get you that'll get you $500. 5 million, you get $1,000, and once you hit the $10 million, you'll get a $2,500 gift card, but you'll also enter what we've almost jokingly called the PMA Platinum Playground, and that gets you lifetime membership into that. Sort of acknowledging that you're a serious referrer to us, and just acknowledging that we'll give you a $500 gift card every single year, provided you send at least $1 million through to us. So this is just an additional thing we do to reward our referrers. What I want to look at now is just understanding the short-term lending process. As I've said, it's all about flexibility, but it's also about speed. So we really want a streamlined process, and this is what we've come up with. Initially, you just need to submit an application form, or you can submit a one-page quick app. So our quick app is literally, it's just a one-page document. You can fill the real high-level details of a deal and shoot it through to us. We'll do the initial assessment for free and come back to you with what we call an indicative letter of offer. So that'll let you know exactly what the indicative rate is, how much the assessment fee is, how much the legal fees are going to be, how much you're going to get paid. So it's just got everything, all the details there that the client needs. And as soon as that is accepted and the assessment fee is paid, that's when we finalise all our due diligence. So okay, that's when we do all our, the title searches and checks and credit checks and all that sort of thing, before we then produce the formal letter of offer. And then shortly after the letter of offer is signed, we get the legal docs done. We use solicitors who specialise in short-term lending, and what that means is they're unlike normal solicitors in that they do things quickly. So they know that when we send something to them, 24 hours is sort of the maximum time. We've had them do 2-hour turnaround times for docs. Okay, so it's all about the speed in which they can get the documentation through to the borrower. And then finally we then proceed to settlement. So it's a really quick process, and we might like to make it as quick and as easy as possible, not only for the referrer but also for the borrower. So let's look at what we look at. So if you're looking to refer a deal to us, this is sort of the process that we go through of qualifying a deal. So we sort of like to educate our referrers of what we look for, to sort of save time for you, but also for us in qualifying a deal, just to make sure it's actually going to go forward. So we call this our first filter. So the very first thing is the loan non-coded? So at the start I said we only do business loans, so it has to be a non-coded purpose. So just to sort of go into this a little bit further, is so looking at what is a coded loan versus what is a non-coded loan. So the first thing we look at is who is the borrower. So if it's a corporate borrower, so your borrower is borrowing it through a company name, then automatically it's deemed to be non-coded. Okay, so very, very simple. And they're the ones we like. It just makes it nice and easy. If it's an individual borrower, if it's for domestic purposes, like the purpose of the loan is domestic purposes, then it's a coded loan and we can't do it. If it's for business purposes, like they're buying into a business or they're buying some trading stock for their business, something like that, then it's non-coded. The other thing we look at is the type of security. So if it's a commercial property, then obviously, it's a commercial loan, it's a non-coded loan. If it's for residential property, the purpose, once again, it must be for business purpose. So the next thing we look at is the interest rate. Okay, so the minimum interest rate that we'll charge is 1% per calendar month. So the client needs to be prepared to pay at least 1% per month, otherwise the deal's not going to fly. Okay, we're not a bank who has a 30-year loan and wants a million bits of documentation and wants 6 to 8 weeks to do the loan. So I suppose it's about setting the expectation with the client that they're not going to get a 4 to 5% interest rate, that they start at 1%. And obviously if it's a second mortgage they're looking for, they need to understand that it's at least 1.5% per month. The next thing we do as our check is the postcode and LVR, or loan to value ratio check. So that's that table that we went through at the start of the webinar, looking at, okay, where is the property and how much are we typically going to lend on that property. Next one is how much the referrer wants to make. So you as the person coming in referring it, how much do you want to make? So we make sure that obviously that's put into the indicative letter of offer. The next one we look at is probably one of the most important ones, is the exit strategy. So this is how are they actually going to repay the money? How are they going to repay this loan? Because we want to make sure we're setting everyone up for success. We want to make sure that they can pay the loan back at the end of the term. They're not going to just prolong the inevitable and put them into any more stress. One of the biggest things and a lot of reasons that people come through private lending is because it's so short-term in nature, serviceability is not required. Okay, so a lot of banks will knock a loan back because the client can't show adequate serviceability. Whereas a lot of our loans, like let's say someone wanted a loan for say 3 months, we'll actually prepay the loan payments for the 3 months. So the client would get the money, and then 3 months later they just pay back the principal plus the payments. Okay, so they don't need to make payments along the way. So that can be a really good advantage and a really good reason to be able to use private lending. The other thing we look at is, why can't the client get bank finance? Okay, because if the answer is yes, they can get bank finance, don't use us. Very, very simple. We're going to be more expensive than a bank, always. So we want to make sure that they're getting the best rate that they can. So we want to understand why they can't get the bank funding, so we can sort of work out what that issue is and make sure that it's something we can work with. And the last one is, when does the client need to settle? Okay, so it's very much working with the client. It's very short term, and we need to make sure that everyone's working towards a goal. So if the client needs to settle in a week's time, great, let's get that all set up. Let's get all the wheels in motion so that we can settle on time. It's not just it goes into the system and it's ready when it's ready. We very much want to make sure we're working towards a common goal with the client. Okay, I just want to quickly go through an example. This is a real transaction we did. It was a development site in Altona North in Melbourne, and the borrower bought the development site. It was to do a 3 townhouse development, and the building was actually 90% complete, but then they ran out of money. Okay, so they had a few issues with the build, and essentially they were trying to self-fund the development. And yeah, they got very, very close, but they ran out of money, and we call this completion finance. So similar to mezzanine funding, but this is more done at the end of the development, so we call it completion finance. So the first thing is, the borrower was a company. The experience, they had no experience. This was their first development deal. So once again, this is a red flag for a lot of banks. They don't like people who don't have experience, whereas for us it's not as much of an issue. Serviceability, they were self-employed and they had no financials. So once again, was a bit of an issue. The valuation came in as if complete, was $1.95 million. They already had a first mortgage in place of $520,000. They had a build contract in place for $650,000, and they'd already self-funded $250,000. So they'd already put $250,000 of their own cash. So the shortfall they needed to complete the construction was $400,000, and they only needed the money for 2 months. Okay, so just to finish the construction, and then they'd already pre-sold 2 of the townhouses. So that was their exit strategy. So if we then run our filter, so the first filter, it's non-coded because it was a company borrower, nice and easy. We tick that box. The next one, it was a second mortgage, so yes, the borrower was happy to pay 1.9% per calendar month. The postcode was category 1 and the loan to value ratio was less than 65%, so once again that passed that check. The referrer wanted to make 0.6%, so that's fine, we added that into the approval fee. The exit strategy was the sale of the units. The clients couldn't get bank finance for a myriad of reasons. They were self-employed, they didn't have financials, they got no experience, and probably the biggest one was time frame. They didn't have the time to wait for a bank to come through to refinance their first mortgage. And the client needed to settle as soon as possible. They actually had an outstanding invoice to the builder of $330,000. To the point where the builder had actually stopped work and said, I'm not going to do anything until you pay my outstanding invoice of $330,000. Okay, so they really needed the funding, yesterday. They needed it as soon as possible. So the solution was we provided a $435,000 second mortgage. So they needed $400,000. The other $35,000 was their prepaid interest. So we prepaid their payments for the first 2 months and also covered their approval fee. So their interest rate was 1.9% per month. They had a 2-month loan, and like we do with all our loans, we provided them 6 months worth of extensions. The approval fee was 2.6%, so 0.6 of this went to the referrer. So the biggest way that we recommend any client really to look at short-term lending is it's all about the total cost of the loan. It's not about the interest rate. Okay, the interest rate is almost irrelevant. Okay, if you look at the total cost of the loan, that includes the interest rate. Okay, so some people might say, look, some lender's going to do it at 1.8% per calendar month, but if their approval fee is $50,000, you can see it kind of doesn't make sense. You see, to compare apples with apples, you really need to look at the total cost of the loan. So in this example, the interest for the client was $16,530 for the 2 months. The approval fee was $12,441, and the legal admin cost was $5,500. So the total cost of the loan for the client was $34,471. Now, why this is very valuable is it starts becoming quite an easy question for the borrower to make. Is it worth $34,000 for them to get this deal over the line? So this is some mock-up figures that we looked at for the client. So the gross realisation value was $1.95 million. They purchased the land for $650,000. They had some stamp duty costs. They had the build costs. They also had we estimated the agent, council and holding costs that are around about $115,000. So all up, the client was going to make a gross profit of $500,000. So the question is, does it make business sense to give away 7% of your profit, give away $34,000 to get the deal done? Okay, pretty easy decision to spend $34,000 to make $500,000. So that's the way we like people to look at. Does private lending make sense to them? Does this loan actually make sense? For me, to spend $34,000 to make $500,000, very, very easy decision. If the client was going to spend $34,000 to make $40,000, you're probably going to question whether or not they're going to actually do the loan. Okay, so that just makes it nice and easy decision for the client to make. Okay, here's a few of the other things that we specialise in. Okay, it's not just development funding or completion finance that we do. We mainly specialise in urgent funding, so someone that can't wait for the traditional bank time frame, but also for people who fall outside the bank's lending criteria. So it might be they might have an ATO debt. Okay, all banks hate ATO debts. They will not lend you if you've got an outstanding debt to the ATO. So we can come in and finance them out. Get their ATO portal clear, and then nice and easy for them to go and get refinanced with a traditional lender. Another thing we've done is refinancing existing caveat loans. So a client may have gone and got a very, very expensive caveat loan from another private lender, and it may be in default at I've seen interest rates as high as 15% per calendar month. That they need some urgent funding, that we can come in with another facility that's going to be significantly cheaper to help that client out. Another big one that we do that no bank will do a lot of the time, especially if it's not commercial, is valuation, not contract. Okay, we live in the real world. We understand that a client can buy a property under market value. So we're happy to lend on the higher of valuation on contract price, okay, provided it's something we can see that there's some value there, and we've instructed the valuer to go out and do it. The next thing, we have people who are paying out business partners. We have people who have urgent business opportunities, so maybe they can buy something from a competitor really cheap, or they need to buy some stock at a discount, but once again they need the money very quickly. Developers, as I said, we've gone through that scenario where they might need some construction facility, or they might need that completion finance where something's gone wrong and they need some short-term funding to complete the project. The other big one for us is credit impaired. So we don't really mind if they've got some credit issues. For us, it's more about that exit strategy as opposed to the credit of the client. We're more looking at the asset than the client. So it's more about that asset funding that we look at rather than the actual person and their serviceability and all that sort of thing. Okay, borrower beware. Now, just as we're going along, if you have just joined us, please note you can, if you want to ask any questions, you can type your questions into the little box on your little control panel there. We're happy to answer any questions you've got at the end of the presentation. So what I want to cover now is just, and this is what we do a lot of education around, as private lending becomes more and more sort of mainstream, a lot of these other lenders out there, some other private lenders that are doing some pretty dodgy stuff in my opinion, they're just getting stamped out because they're just being caught on and being called on what they're doing. And here's some of the other things that we've seen in the marketplace that just you need to be aware of if you're going to a private lender that's not Private Mortgages Australia. So the things they'll do is from rates. So they might say we've got interest rates from 1%, but there's no upper limit. So they might get your client in on saying, oh yep, come in, we've got interest rates from 1%. And but then when the actual offer comes back, it might be at 5%, 6% a month. Okay, you never know what the upper edge of the envelope is going to be for that offer. The other big one is big upfront fees before the final offer. Okay, so I saw one the other day where the client got charged $18,000 before they even had the offer. Okay, so before they even got the offer from the person, from the lender, they had to pay $18,000. Okay, so we've seen a lot of this where they get the client to pay big upfront fees on the promise of the money, and then they'll order a valuation, and they basically, they'll ask for the valuation to be done for a forced sale, or really low valuation, so the loan doesn't stack up, and they go, thanks very much, we're going to keep your $18,000, thanks for coming. Okay. These lenders that make money on upfront fees rather than lending money, just be very careful of that. The other one we see is these 24-hour loans. Okay, very few lenders in Australia can actually do a loan within 24 hours. And Private Mortgage Australia, we can't. We've never done a loan in 24 hours. We can do it within a couple of days, but just be careful of someone who's saying they're going to do a loan in 24 hours, because typically what we see will happen, and what we hear from borrowers that have sort of got burnt, is that they got locked into these 24-hour loans, and they sign up and they pay all these fees, and then when the loan hasn't come through in 24 hours, they say, oh, it'll be another 24 hours or another 24 hours. And it's just to get them into the system. And they know that once they've got you, that you're going to stay there, because they know you don't want to go and start the whole process again with another lender. So I often, if you are going to go to one of those lenders, ask them, how many loans have you actually settled within 24 hours? Okay, it's probably 1% of their loans, if ever, that they've done that. The other one I briefly spoke about before is where the lender will actually, they'll make a profit on the valuation, so they charge more than it's actually costing them to get the valuation, but then they go and get a forced sale valuation where they're pretty much telling the valuer, please value this, 20% under market value, because they don't actually want to do the loan, they just want to keep the fees. The other one we see is cancellation fees, where they will get you to sign, even in their indicative letter of offer, they'll have a cancellation fee. So if the loan doesn't proceed, even if the lender doesn't want to proceed, they'll charge a cancellation fee, and it might be a couple of percent. It might be 10, 20, 30, 40, I even saw $50,000 the other day as a cancellation fee, even if it's just the lender who doesn't want to proceed. And what they'll do is they've got a charging clause in the indicative letter of offer where they'll then put a caveat on the client's property. They'll also put a PPSR charge, a personal property security register charge against the client. And pretty much what they'll do is they'll hold those properties to ransom until they get paid their cancellation fee. Okay, so just be very careful of charging clauses, especially when it's in the indicative letter of offer, before the client's even seen, what the interest rate's going to be or what the fees and charges are going to be, before the lender's even said that yes, they're going to proceed with the loan. So that's and this really leads us into what we call the PMA way. And we're all about cleaner loans to get better results. Okay, we're going to be here for the long haul. We're here for decades. We're not about just doing a quick loan. These fly-by-night sort of lenders. And the way we do that is pretty much doing the opposite of what a lot of other lenders do in the marketplace, where we only charge a very, very low upfront assessment fee, literally just to cover our costs. We've got no charging clauses in our indicative letter of offer, and there's no cancellation fees in our indicative letter of offer either. So they can put their indicative letter of offer in, they can sign it, and there's nothing else that they're going to need to pay. The only thing that they will lose is the small upfront assessment fee that they pay upfront. All our valuations are done at cost, and we also do it for a reasonable value. So we'll do it for market value purposes or for mortgage purposes. Okay, we're not going to do it for a forced sale. Any legal fees are also done at cost, and we've also got a capped interest rate range. Okay, so our first mortgages are going to be between 1% and 2.5% per month. Okay, we're not going to come back and suddenly it's 5% or 12% a month or anything crazy like that. The other thing we do is we always offer 6 months worth of extensions to our clients. Now, if a client pays an extension payment, so they extend their facility by 1 month by paying 1 month's interest in advance. Let's say they extend for a month and then they pay the facility back 1 week later. We'll actually refund the 3 weeks worth of interest that they didn't use. Okay, just it's all about being fair, and so that's what we do with the extension payments. The only time we won't refund interest is the prepaid loan term. So if they've prepaid the loan for 2 months, then they've locked in that for 2 months. Okay, so just for the extension payments, we'll refund the interest for anything they don't use. The other thing we've built, we've got some custom-built software that we've made so that we can process deals faster, because it's all about speed and flexibility with lending. So we've spent a phenomenal amount of money and a couple of years developing this software so that we can be faster than other lenders in the marketplace. Probably the thing that we're really proud of is our high level of repeat customers. Okay, we want people to have a good feeling about and a good experience when they come and have a loan with PMA. So where we know we're doing really well is when a client comes back and they say, yes, great, I had a great experience, I want to lend, I want to borrow again and again and again from us. So whereas a lot of other lenders, they'll have a client once and then that's it. They'll never come back again because they had a horrible experience with them. So that's something we're very proud of, to have a high level of repeat customers. For us, it's all about a win-win approach to lending. It has to be a win for everyone. It has to be a win for the borrower, us as the lender as well, but also the referrer. Now, you may have seen just recently some recent news. We've been covered last month we've had some really exciting news. Because of the growth we've actually had to take on a new staff member, and we've got a really lucky to have a star member come in, Royce, and this is our new senior relationship manager. Royce brings in a significant amount of experience in banking. He's been doing it for full-time for 16 years, but more importantly, those 16 years has been in asset finance, corporate banking, and now private lending. Okay, so he's got the experience in what we're dealing in, and very impressive, especially for someone like me that can only barely speak English. Is he's got 4 languages under his belt, so just can be really handy, especially if you've got a client that maybe speaks Mandarin or Cantonese, just sort of getting some of those financial concepts across. That he can do that. So we're really excited to have Royce on board, and so he's our new senior relationship manager. And just on here we've got his contact details, so if you have any loan scenarios that you want to run past, or any questions about what we sort of covered, please contact Royce. He's got his mobile number and email there. The other thing you can also do is check out our website, which is privatemortgagesaustralia.com.au, and yeah, we've got heaps of resources on there. You can download our application form, our one-page quick app form. There's heaps of resources on there. As I said before, you've got the mandate on there that you can download. So what I'll do, I'll just open it up. If anyone's got any questions, we'll just finish it. Anyone's got any questions? If you don't have a question, that's fine. We hope you got a lot out of it. If you've got any feedback for us, please shoot us an email. We always like to hear if there's anything more information that you want to find out about. We're always happy to cover it in the webinars. We're in the process this year, actually this month, we're going into the studio, and we're going to record, to start with, just 10 short 2-minute videos on different things with private lending. So, what is private lending? What's a first mortgage? How does development finance work? Where do we get the funding from? We go through a few case studies. So just look out for those. We'll be sending those through, so that just so the marketplace is aware of what private lending is and what place it has. So, guys, what we'll do, because I'm sort of conscious of time here as well, is we might leave it there. We are going to have the recording of this done afterwards, so you can have a bit of a look, or if you want to share it with your team members, we're happy to make that available, as well as the slides. The other thing we'll do as well, for all the referrers, especially the mortgage brokers, we know you have to get your yearly CPD points. So we'll actually send you out a certificate for half a CPD point for this, just so you've got something on file for those. So guys, thank you very much for listening, and yeah, we look forward to working with you and your clients soon. Thanks.